Question 1. Which of the following best describes the primary purpose of reinsurance? A. To reduce the potential profits of the insurer by transferring risk to other parties. B. To ensure that an insurance company does not bear the entire financial risk of large losses. C. To eliminate all financial risk associated with underwriting insurance policies. D. To provide a way for insurance companies to avoid regulatory oversight by outsourcing risk. Answer: B. To ensure that an insurance company does not bear the entire financial risk of large losses. Explanation: Reinsurance primarily serves to spread the risk of loss across multiple parties, ensuring that the ceding insurer does not face overwhelming financial consequences from large or catastrophic losses. The goal is not to eliminate all financial risk, but to manage it more effectively by transferring a portion of it to another insurer. Option A is incorrect because reinsurance is not about reducing insurer profits, but about managing risk. Option C is incorrect because reinsurance does not completely eliminate financial risk. It mitigates it. Option D is also incorrect as reinsurance does not allow insurers to bypass regulations, but is regulated itself by agencies like the California Department of Insurance, CDE. Question 2. Mr. Thompson is a reinsurance underwriter at an insurance company in California. He is reviewing a treaty reinsurance agreement that his company has signed with a foreign reinsurer. The treaty specifies that the reinsurer will cover 70% of losses above $1 million for all claims related to automobile accidents, with the insurer retaining the first $1 million in losses. Based on this information, which of the following statements is correct? A. The reinsurer will pay 70% of all losses, regardless of the amount. B. The insurer will pay the first $1 million in losses, and the reinsurer will cover 70% of the remaining amount above that threshold. C. The reinsurer is responsible for all claims exceeding $1 million. D. The treaty agreement applies to all types of claims, not just to automobile accidents. Answer: B. The insurer will pay the first $1 million in losses, and the reinsurer will cover 70% of the remaining amount above that threshold. Explanation: This question describes a quota share type of reinsurance where the insurer retains the first $1 million and the reinsurer covers 70% of the losses above that amount. In this scenario, the reinsurer's liability is triggered once losses exceed $1 million and they cover a portion of the excess losses. Option A is incorrect because the reinsurer does not cover all losses, only those above the $1 million threshold. Option C is incorrect because the reinsurer is not responsible for all claims exceeding $1 million. They only cover 70% of losses above that amount. Option D is also incorrect, as the treaty explicitly applies to automobile accidents and the reinsurer's obligations are not extended to all types of claims. Question 3. Which of the following is the primary difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves the reinsurer assuming a fixed percentage of both premiums and losses, while non-proportional reinsurance involves the reinsurer only covering losses above a certain threshold. B. Proportional reinsurance is used to cover specific lines of business, while non-proportional reinsurance is used for catastrophic events only. C. Non-proportional reinsurance guarantees the reinsurer will pay all, while proportional reinsurance only covers a percentage of the premiums. D. Proportional reinsurance is primarily used in facultative agreements, while non-proportional reinsurance is mainly used in treaty agreements. Answer A. Proportional reinsurance involves the reinsurer assuming a fixed percentage of both premiums and losses, while non-proportional reinsurance involves the reinsurer only covering losses above a certain threshold. Explanation: The key difference between proportional and non-proportional reinsurance is how losses and premiums are shared. In proportional reinsurance, the reinsurer and the insurer share both the premiums and the losses in a percentage, such as in quota share or surplus share arrangements. In non-proportional reinsurance, the reinsurer only covers losses that exceed a predefined threshold, such as in excessive loss or stop-loss reinsurance. Option B is incorrect because both types of reinsurance can be used for various types of risks, not just specific lines or catastrophic events. Option C is incorrect because non-proportional reinsurance does not guarantee payment of all losses, but rather covers losses above a certain threshold. Option D is incorrect because both proportional and non-proportional reinsurance can be used in both facultative and treaty agreements depending on the arrangement. Question 4. Which of the following is the most likely reason an insurer would enter into a treaty reinsurance agreement with a foreign reinsurer? A. To bypass the regulatory oversight of the California Department of Insurance, CDI. B. To transfer the risk associated with high value or catastrophic events to a more financially stable reinsurer. C. To avoid paying taxes on the reinsurance premiums. D. To increase the premiums received by the insurer by pooling resources with the reinsurer. Answer: B. To transfer the risk associated with high value or catastrophic events to a more financially stable reinsurer. Explanation: Treaty reinsurance agreements allow insurers to transfer large, potentially catastrophic risks to reinsurers, particularly those with greater financial resources or global reach. This helps insurers stabilize their financial position by sharing the risk of significant losses. Option A is incorrect because reinsurance agreements, including those with foreign reinsurers, are still subject to regulation by the CDI. Option C is incorrect because reinsurance premiums are generally taxable, and there is no inherent tax avoidance strategy in treaty reinsurance. Option D is incorrect because treaty reinsurance does not increase the insurer's premiums, but rather spreads out the risk to reduce the insurer's exposure. Question 5. Which of the following is a key feature of the quota share reinsurance arrangement? A. The reinsurer covers all losses above a set limit, typically in excess of $1 million. B. The insurer and reinsurer share premiums and losses according to a fixed percentage. C. The reinsurer is responsible for all claims below a specific threshold. D. The reinsurer provides coverage only in the event of a major catastrophe. Correct answer: B. The insurer and reinsurer share premiums and losses according to a fixed percentage. Explanation: In a quota share reinsurance arrangement, both the insurer and reinsurer share the premiums and losses according to a fixed percentage, such as 70% for the reinsurer and 30% for the insurer. This allows the insurer to reduce its exposure to large losses by spreading the risk with the reinsurer. Option A describes excessive loss reinsurance, not quota share. Option C is incorrect because quota share involves a shared approach to both premiums and losses, not a separate responsibility for certain claims. Option D is incorrect as quota share reinsurance is not limited to catastrophic events. It is applicable to regular claims within the agreed upon percentage. Question 6. Which of the following statements about reinsurance brokers is most accurate? A. Reinsurance brokers represent only the ceding insurer negotiating reinsurance contracts on their behalf. B. Reinsurance brokers act as intermediaries, facilitating communication and agreement between insurers and reinsurers. C. Reinsurance brokers are authorized to underwrite reinsurance policies on behalf of the reinsurer. D. Reinsurance brokers only handle facultative reinsurance contracts, not treaty agreements. Answer: B. Reinsurance brokers act as intermediaries, facilitating communication and agreement between insurers and reinsurers. Explanation: Reinsurance brokers act as intermediaries between ceding insurers and reinsurers, facilitating the negotiation and placement of reinsurance contracts. They do not underwrite policies, but help both parties come to mutually beneficial terms. Option is incorrect because brokers represent both parties, not just the ceding insurer. Option C is incorrect because brokers do not have underwriting authority, and they negotiate and facilitate, not write policies. Option D is incorrect because brokers work with both facultative and treaty reinsurance contracts, not just facultative ones. Question 7. Which of the following best describes the concept of loss reserves in reinsurance accounting? A. The amount of money set aside by the reinsurer to cover future policyholder claims. B. The money paid by the ceding insurer to the reinsurer as a premium for the reinsurance agreement. C. The funds required to cover the reinsurer's operating expenses. D. The amount of capital set aside to satisfy solvency requirements under regulatory guidelines. Answer A. The amount of money set aside by the reinsurer to cover future policyholder claims. Explanation: Loss reserves represent the estimated amount of money that a reinsurer must set aside to cover claims that have occurred but not yet been paid. These reserves ensure that the reinsurer has sufficient funds to meet its obligations to policyholders. Option B describes reinsurance premiums, not loss reserves. Option C is incorrect because operating expenses are not part of loss reserves, which are specifically allocated for claims. Option D refers to capital set aside for solvency purposes, which is separate from loss reserves. Question 8. Which of the following is a key advantage of non-proportional reinsurance for the ceding insurer? A. It guarantees that all premiums are paid in full regardless of claims. B. It provides coverage for losses above a specified threshold, protecting the insurer from catastrophic losses. C. It ensures the reinsurer assumes full responsibility for all claims, eliminating the insurer's risk. D. It is simpler and more predictable than proportional reinsurance. Answer: B. It provides coverage for losses above a specified threshold, protecting the insurer from catastrophic losses. Explanation: non-proportional reinsurance is designed to provide coverage for losses that exceed a specific threshold, which helps protect the ceding insurer from catastrophic or large losses. This type of reinsurance is particularly useful for managing exposure to rare but large events. Option is incorrect because non-proportional reinsurance does not guarantee full premium payments. Option C is incorrect because non-proportional reinsurance does not transfer all risk but only covers losses above a specified limit. Option D is incorrect because non-proportional reinsurance is more complex, requiring detailed definitions of thresholds and coverage. Question 9. Mr. Parker works for a reinsurer and is reviewing a facultative reinsurance agreement. The agreement covers a large commercial property policy where the total coverage limit is $10 million. Mr. Parker notices that the reinsurer will assume 80% of the risk on losses exceeding $5 million, with the insurer retaining the first $5 million. What type of reinsurance arrangement is Mr. Parker reviewing? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Stop loss reinsurance. D. Surplus share reinsurance. Answer: B. Excessive loss reinsurance. Explanation: this is an example of excessive loss reinsurance where the reinsurer covers losses that exceed a certain threshold, in this case losses above $5 million. The insurer retains the first $5 million of the loss and the reinsurer covers the excess. Option is incorrect because quota share reinsurance involves sharing premiums and losses in fixed percentage, not based on threshold. Option C is incorrect because stop loss reinsurance limits the total loss the insurer can suffer over a defined period rather than on individual claims. Option D is incorrect because surplus share reinsurance is similar to quota share but focuses on higher limits and is not defined by excess losses. Question 10. Which of the following is true regarding reinsurance treaties? A. Reinsurance treaties are mandatory for insurers to enter into. B. Reinsurance treaties are generally written on a case-by-case basis for each individual risk. C. Reinsurance treaties provide a framework for ongoing reinsurance coverage over a specified period. D. Reinsurance treaties only apply to domestic insurers and do not include foreign reinsurers. Answer: C. Reinsurance treaties provide a framework for ongoing reinsurance coverage over a specified period. Explanation: reinsurance treaties provide an ongoing framework for reinsurance coverage, typically covering a specified period, such as 1 year. These treaties outline the terms under which reinsurers will cover losses for the insurer. Option is incorrect because reinsurance treaties are not mandatory. Insurers may choose to enter into them. Option B is incorrect because treaties are typically broad agreements that apply to multiple risks, not case-by-case arrangements. Option D is incorrect because reinsurance treaties can involve both domestic and foreign reinsurers, depending on the agreement. Question 11. Which of the following is a common reason for an insurer to enter into a facultative reinsurance agreement rather than a treaty reinsurance agreement? A. The insurer wants to cover risks that fall outside of the scope of their existing treaty reinsurance. B. The insurer prefers to share risk on a broader basis with multiple reinsurers. C. The insurer wants a more standardized and ongoing coverage arrangement. D. The insurer has a high volume of small claims that it seeks to share across a treaty arrangement. Answer A. The insurer wants to cover risks that fall outside of the scope of their existing treaty reinsurance. Explanation: facultative reinsurance agreements are typically used for specific individual risks that may not be covered under a broader treaty reinsurance agreement. This type of reinsurance allows the insurer to cede risk on a case-by-case basis, providing flexibility for non-standard or high-value risks. Option B refers to treaty reinsurance, which is typically written on a broader ongoing basis. Option C refers to treaty reinsurance, not facultative. Option D pertains to smaller claims and is more related to treaty reinsurance. Question 12. Which of the following types of reinsurance is most likely to be used by an insurer to mitigate the risk of a large single catastrophic loss? such as a natural disaster. A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is used by insurers to cover catastrophic losses that exceed a certain threshold. This type of reinsurance is designed to limit an insurer's exposure to large, unpredictable events such as natural disasters, as it covers losses above a specific amount. Option A refers to quota share reinsurance, which shares premiums and losses on a proportional basis. Option B describes surplus share reinsurance, which shares a portion of the loss, but typically for losses that exceed the insurer's retention. Option D describes stop-loss reinsurance, which helps insurers control the total loss over a period but is less focused on large single events. Question 13. Which of the following is a key advantage of treaty reinsurance over facultative reinsurance? A. Treaty reinsurance is generally more flexible and customized to individual risks. B. Treaty reinsurance involves an ongoing automatic coverage arrangement that reduces administrative effort. C. Treaty reinsurance allows the insurer to transfer risk for specific high-value properties. D. Treaty reinsurance offers more direct control over the cession of individual risks. Answer: B. Treaty reinsurance involves an ongoing automatic coverage arrangement that reduces administrative effort. Explanation: treaty reinsurance provides an automatic and ongoing coverage arrangement, making it more efficient and reducing the administrative burden for both the ceding insurer and the reinsurer. Facultative reinsurance, on the other hand, is negotiated on a case-by-case basis, requiring more administrative effort. Each individual risk option is incorrect because treaty reinsurance is generally broader and less customized than facultative reinsurance. Option C describes facultative reinsurance, not treaty reinsurance. Option D is incorrect because treaty reinsurance does not provide direct control over the cession of individual risks. It applies to a broader group of risks. Question 14. Which of the following clauses is most commonly included in a reinsurance contract to prevent the reinsurer from being liable for claims arising from certain pre-existing conditions or situations? A. Reinstatement clause. B. Exclusion clause. C. Cession clause. D. Premium clause. Answer: B. Exclusion clause. Explanation: exclusion clauses in reinsurance contracts are designed to limit or eliminate the reinsurer's liability for certain risks or conditions, such as pre-existing conditions, specific exclusions, or high-risk situations. This protects the reinsurer from having to cover losses related to these excluded circumstances. Option A refers to a clause that allows for the reinstatement of coverage after it has been exhausted, but it does not limit liability. Option C refers to a provision related to the ceding of risks under the agreement. Option D refers to the agreement on premiums, but it is not directly related to liability exclusions. Question 15. Which of the following is an example of a reinsurance provision that outlines the process for resolving disagreements between the ceding insurer and the reinsurer? A. Reinstatement provision. B. Arbitration clause. C. Claims made clause. D. Surplus clause. Answer: B. Arbitration clause. Explanation: an arbitration clause is typically included in reinsurance agreements to establish a method for resolving disputes between the ceding insurer and the reinsurer. Arbitration provides a structured process where an independent third party makes a binding decision on the matter. Option A refers to the reinstatement of coverage after a loss is paid, which does not address dispute resolution. Option C refers to the type of coverage trigger, e.g., occurrence or claims made, not dispute resolution. Option D refers to provisions related to surplus share reinsurance, not dispute resolution. Question 16. Which of the following best describes the concept of finite reinsurance? A. A type of reinsurance that provides coverage for an indefinite period. B. A reinsurance arrangement designed to limit the reinsurer's exposure while providing capital relief to the ceding insurer. C. Reinsurance arrangement where the insurer retains all the risk below certain threshold. D. Reinsurance arrangement focused on covering operational risks rather than underwriting risks. Answer: B. A reinsurance arrangement designed to limit the reinsurer's exposure while providing capital relief to the ceding insurer. Explanation: Finite reinsurance is designed to provide financial relief for the ceding insurer by offering limited reinsurance coverage while also limiting the reinsurer's exposure. These arrangements often include funding or capital relief features and may have specific term or structure designed to meet the insured's solvency or regulatory needs. Option is incorrect because finite reinsurance is not indefinite in duration. Option C refers to certain types of proportional reinsurance arrangements. Option D is incorrect because finite reinsurance focuses on underwriting risks and solvency, not operational risks. Question 17. What is the primary regulatory function of the California Department of Insurance, CI, in relation to reinsurance? A. To set the reinsurance premiums charged by reinsurers. B. To approve and regulate reinsurance treaties and agreements. C. To directly manage the ceding insurer's reinsurance contracts. D. To provide reinsurance coverage for insurers facing insolvency. Answer B. To approve and regulate reinsurance treaties and agreements. Explanation. The California Department of Insurance, CDIA, plays a key regulatory role in overseeing and approving reinsurance treaties and agreements. The CEI ensures that reinsurance arrangements are in compliance with California's insurance laws and that insurers and reinsurers maintain financial stability. Option is incorrect because the CDI does not set reinsurance premiums, which are negotiated between the ceding insurer and the reinsurer. Option C is incorrect because the CEI does not directly manage individual reinsurance contracts. Option D is incorrect because the CEI does not directly provide reinsurance coverage. Question 18. Mr. Thompson is reviewing a treaty reinsurance agreement in which the reinsurer will assume 70% of the losses exceeding $1 million, with the ceding insurer retaining the first $1 million of any loss. What type of reinsurance is Mr. Thompson reviewing? A. Surplus share reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Facultative reinsurance. Answer B. Excessive loss reinsurance. Explanation. This agreement describes an excessive loss reinsurance arrangement where the reinsurer covers losses above a certain threshold, in this case $1 million. The ceding insurer retains the first $1 million of any loss and the reinsurer assumes the excess. Option A refers to surplus share reinsurance, which involves sharing losses on a proportional basis based on the insurer's retention level. Option C refers to quota share reinsurance, where both premiums and losses are shared in fixed percentages. Option D refers to facultative reinsurance, which applies to specific, individual risks. Question 19. Which of the following is a key feature of a proportional reinsurance? A. The reinsurer assumes all of the risk above a specific threshold. B. The ceding insurer and reinsurer share both premiums and losses in a fixed percentage. C. The reinsurer only provides coverage for catastrophic events. D. The ceding insurer retains all risk below a specified amount and cedes the rest to the reinsurer. Answer B. The ceding insurer and reinsurer share both premiums and losses in a fixed percentage. Explanation. Proportional reinsurance involves the ceding insurer and reinsurer sharing both premiums and losses according to a fixed percentage. This type of reinsurance is often used for smaller, more predictable risks. Option A describes excessive loss reinsurance, not proportional reinsurance. Option C is incorrect because proportional reinsurance applies to a broader range of risks, not just catastrophic events. Option D refers to a surplus share reinsurance arrangement, not proportional. Question 20. Which of the following is true regarding the reinstatement clause in a reinsurance agreement? It allows the ceding insurer to reinstate coverage after a loss has been paid, typically for an additional premium. B. It limits the reinsurer's liability to a single claim only. C. It provides the reinsurer with a method for appealing a loss determination by the ceding insurer. D. It stipulates the maximum amount of loss that can be covered by the reinsurer under any circumstance. Answer A. It allows the ceding insurer to reinstate coverage after a loss has been paid, typically for an additional premium. Explanation. The reinstatement clause in a reinsurance agreement allows the ceding insurer to reinstate the coverage after loss has been paid, usually by paying an additional premium. This ensures that the ceding insurer can maintain coverage limits even after large claims have been made. Option B is incorrect because the reinstatement clause does not limit liability to a single claim. Option C is incorrect because the reinstatement clause is not related to appeal rights. Option D refers to coverage limits, but the reinstatement cause is about reinstating coverage after a loss, not establishing maximum limits. Question 20 on which of the following best describes the concept of risk retention in reinsurance? A. The process of transferring all risks to a reinsurer. B. The decision by a ceding insurer to retain part of the risk rather than cede it to a reinsurer. C. The act of reinsurers pooling their resources to cover high-value losses. D. The requirement for reinsurers to maintain a capital surplus equal to the total retained risk. Answer. B. The decision by a ceding insurer to retain part of the risk rather than cede it to a reinsurer. Explanation. Risk retention refers to the ceding insurer's decision to retain a portion of the risk instead of transferring all of it to a reinsurer. This is done to maintain control over the risk or when the cost of reinsurance is high. Option is incorrect because it refers to transferring all risk, which is not risk retention. Option C is incorrect because pooling resources refers to another practice in reinsurance, but not specifically risk retention. Option D is incorrect as risk retention doesn't mandate specific capital surplus. Question 22. In the context of reinsurance treaties, what is the primary difference between a quota share reinsurance and a surplus share reinsurance? A. Quota share reinsurance cedes a fixed percentage of each policy, where a surplus share cedes the portion of a policy's risk exceeding the retention limit. B. Quota share reinsurance only applies to high-value risks, while surplus share is used for standard risks. C. Quota share reinsurance involves only facultative arrangements, whereas surplus share is always treaty-based. D. Surplus share reinsurance is always retroactive, while share is prospective in nature. Correct answer. A. Quota share reinsurance cedes a fixed percentage of each policy, whereas surplus share cedes the portion of a policy's risk exceeding the retention limit. Explanation. Quota share reinsurance involves ceding a fixed percentage of all premiums and losses for policies within the agreement irrespective of the individual risk's value. Surplus share reinsurance, on the other hand, allows the ceding insurer to retain a specific amount of the retention limit and cede only the surplus above that limit. Option B is incorrect because both quota share and surplus share can apply to various types of risks, not just high-value or standard risks. Option C is incorrect because both types can be treaty-based or facultative. Option D is incorrect as both quota share and surplus share are typically prospective in nature. Question 23 scenario. Mr. Anderson is the risk manager for a large insurer in California. He is negotiating a treaty with a reinsurer that covers his company's auto insurance policies. The treaty includes a cessation provision, meaning that the insurer can stop ceding certain policies to the reinsurer if the reinsurer fails to meet specific requirements. What should Mr. Anderson consider when reviewing this provision? A. He should ensure that the cessation provision is linked to solvency standards for the reinsurer. B. He should disregard the provision since it only applies in extreme circumstances. C. He should make sure that the cessation provision allows the reinsurer to terminate the agreement at any time. D. He should request that the cessation provision be linked to the frequency of claims reported. Answer A. He should ensure that the cessation provision is linked to solvency standards for the reinsurer. Explanation. A cessation provision is designed to allow the ceding insurer to stop ceding policies to the reinsurer if certain conditions are met, such as the reinsurer failing to maintain solvency. Mr. Anderson must ensure that the cessation provision is linked to solvency standards to protect his company's financial interests. Option B is incorrect because cessation provision should not be ignored as it is crucial for risk management. Option C is incorrect because the cessation provision should not allow the reinsurer to unilaterally terminate the agreement. Option D is incorrect because the provision is related to solvency, not the frequency of claims. Question 24. What is the primary purpose of facultative reinsurance? A. To cover risks that are not included in the primary policy. B. To allow the ceding insurer to reinsure specific risks on a case-by-case basis. C. To automatically renew coverage for all policies within the treaty. D. To adjust the premiums paid to the reinsurer based on actual losses. Answer B. To allow the ceding insurer to reinsure specific risks on a case-by-case basis. Explanation. Facultative reinsurance allows a ceding insurer to reinsure specific risks individually rather than as part of a broader treaty agreement. This is typically used when a risk is unusual or exceeds the terms of a treaty reinsurance arrangement. Option A is incorrect because facultative reinsurance doesn't cover excluded risks but specific risks agreed upon. Option C is incorrect because facultative reinsurance does not involve automatic renewal. Each policy is reviewed individually. Option D is incorrect because the premiums in facultative reinsurance are typically negotiated for each risk, not adjusted based on actual losses. Question 25. Which of the following is a key characteristic of excessive loss reinsurance? A. The reinsurer covers a fixed percentage of all losses within a specified retention limit. B. The reinsurer only covers losses above a certain threshold, which is the retention limit. C. The ceding insurer pays a fixed premium to the reinsurer regardless of losses. D. The reinsurer covers all losses below a certain limit, leaving higher losses to the ceding insurer. Answer B. The reinsurer only covers losses above a certain threshold, which is the retention limit. Explanation: excessive loss reinsurance is designed to cover losses that exceed a specified retention limit, with the reinsurer covering the excess above that threshold. It is typically used for large catastrophic losses. Option A describes proportional reinsurance, not excessive loss. Option C is incorrect because excessive loss involves loss-based premiums, not fixed premiums. Option D describes a form of stop-loss reinsurance, not excessive loss. Question 26. In reinsurance accounting, what is the significance of reinsurance recoverables? A. They represent amounts due to the ceding insurer for claims that have already been paid by the reinsurer. B. They are amounts owed by the ceding insurer to the reinsurer for claims underwritten under a treaty. C. They are amounts the ceding insurer expects to recover from the reinsurer for claims that are paid out to policyholders. D. They are premiums that the reinsurer owes to the ceding insurer for ceding risks. Answer C. They are amounts the ceding insurer expects to recover from the reinsurer for claims that are paid out to policyholders. Explanation: reinsurance recoverables are amounts that the ceding insurer expects to recover from the reinsurer for claims that the ceding insurer has already paid out to policyholders. These are recorded as assets on the ceding insurer's balance sheet. Option is incorrect because the recoverables are not amounts due for claims already paid by the reinsurer. They are for claims already paid by the ceding insurer. Option B is incorrect because amounts owed by the ceding insurer are liabilities, not recoverables. Option D is incorrect because premiums paid by the reinsurer to the ceding insurer are not classified as recoverables. Question 27. What is the main distinction between admitted and non-admitted reinsurers in California? A. Admitted reinsurers are authorized to conduct business within California, while non-admitted reinsurers are not. B. Admitted reinsurers are subject to more stringent capital and solvency requirements than non-admitted reinsurers. C. Non-admitted reinsurers do not have to comply with California Insurance Code regulations. D. Non-admitted reinsurers are always foreign companies, while admitted reinsurers are domestic. Answer A. Admitted reinsurers are authorized to conduct business within California, while non-admitted reinsurers are not. Explanation: admitted reinsurers are authorized by the California Department of Insurance (CI) to conduct business in the state and are subject to state regulations and oversight. Non-admitted reinsurers are not authorized to do business in California, but can still reinsure risks on a surplus lines basis. Option B is incorrect because both admitted and non-admitted reinsurers must meet certain capital and solvency standards, though the oversight is different. Option C is incorrect because non-admitted reinsurers must still comply with certain regulations. Option D is incorrect because non-admitted reinsurers can be either domestic or foreign. Question 28. What is the primary benefit of finite reinsurance in comparison to traditional reinsurance? A. It offers the reinsurer an unlimited risk-sharing arrangement. B. It allows for the ceding insurer to reduce its tax liability through a structured contract. C. It is used only for large catastrophic events. D. It involves an arrangement where the ceding insurer retains the full amount of risk but gets financial backing from the reinsurer. Answer B. It allows for the ceding insurer to reduce its tax liability through a structured contract. Explanation: finite reinsurance is a structured arrangement where the reinsurer's involvement is limited and the focus is on managing financial risk, often for the purpose of reducing the ceding insurer's tax liabilities or smoothing earnings. It is not typically used for catastrophic events, as stated in Option C. Option is incorrect because finite reinsurance does not involve unlimited risk sharing. Option D is incorrect because the ceding insurer does not retain full risk. The reinsurer provides financial support. Question 29. What is the key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves sharing a fixed percentage of premiums and losses, while non-proportional reinsurance covers losses above a set threshold. B. Proportional reinsurance is used for high-risk policies, while non-proportional reinsurance applies to low-risk policies. C. Proportional reinsurance involves facultative agreements only, while non-proportional reinsurance involves treaty agreements. D. Non-proportional reinsurance is generally more expensive than proportional reinsurance. Answer A. Proportional reinsurance involves sharing a fixed percentage of premiums and losses, while non-proportional reinsurance covers losses above a set threshold. Explanation. Proportional reinsurance involves sharing a fixed percentage of both premiums and losses between the ceding insurer and reinsurer. Non-proportional reinsurance involves the reinsurer covering losses that exceed a certain threshold, typically on a per-loss basis. Option B is incorrect because both types can apply to various risk levels. Option C is incorrect because both types can be structured as either facultative or treaty agreements. Option D is incorrect because the cost structure depends on various factors, not simply the type of reinsurance. Question 30. In which of the following cases would excessive loss reinsurance be most appropriate? A. When a ceding insurer wants to cover a fixed percentage of all premiums and losses. B. When the ceding insurer is concerned about catastrophic losses that exceed a certain dollar amount. C. When the ceding insurer wants to share risks equally with the reinsurer. D. When the ceding insurer is seeking to improve its risk classification system. Answer B. When the ceding insurer is concerned about catastrophic losses that exceed a certain dollar amount. Explanation. Excessive loss reinsurance is designed to protect the ceding insurer from large catastrophic losses that exceed a specific dollar amount, the retention limit. It is particularly useful in managing risk for extreme events. Option. It describes proportional reinsurance, not excessive loss. Option C refers to proportional reinsurance as well. Option D is incorrect because excessive loss reinsurance is not primarily used for risk classification purposes.